Tell me first your view on the jobs report. What does it say for the Fed?
There was something for everybody in this jobs report, whether you are enthusiastic about the U.S. economy or whether you're worried. So yes, job creation fell well short of what was expected, and it's the lowest in 5 months. But you know what? The unemployment rate came down, hourly work went up, wages went up, revisions. So it's a mixed report, and it will make the Fed even more uncertain and even more tentative about what to do in September.
Right, and in fact, you tweeted out shortly after the report, guys. Let's just show that tweet, because I know, Mohamed, since you left PIMCO, you've become a very active social media maven. You tweeted out, jobs report puts Federal Reserve in complex uncertainty jam as below expectation job creation offset by several other positive factors. So does that tell you then that, that the markets are going to remain very volatile, and this is why we are down over 200 points right now?
So today, absolutely. An indecisive jobs report, a long weekend, and China reopening after a holiday. If you're a trader, you do not want to go long into this weekend. So you're going to see a lot of bets that are pared back in the short term. But over the longer term, we are transitioning paradigms, and it's really important to understand this. We are going from a paradigm of low volatility, a low growth equilibrium global economy, all this helped by central bank, to a paradigm of much higher volatility and a much more uncertain global economy. So we are shifting paradigms, and we are going to reprice in a volatile manner, up and down, for the next few weeks at least.
But then what would a rate hike do to that volatility, Mohamed?
So that's the basic issue, Betty. And you've heard me, I've been supportive of a rate hike for a long time.
Yep.
But I believe that if they were to hike in September, it would be doing the right thing at the wrong time. Why is it the right thing? Because the U.S. economy is ready for a slow normalization of monetary policy. The U.S. economy is in relatively good shape, and monetary policy should be normalized gradually. Why would it be the wrong time? Not because of what's happening in the U.S., but what's happening in the global economy. There's a real risk that if you hike now, you end up doing what China did with its currency change a few weeks ago. You end up fueling global instability, and then you have to worry about the spillback onto the economy. So I suspect they won't hike this month.
Okay, so they won't hike this month. And I mean, it almost feels like, when is there ever, Mohamed, the right time? So when is a likely right time?
So you need one of two things for the right time. Either you need an alignment of domestic and global conditions, and we had that early in the year, and that's why you heard me encourage them to hike early in the year. Or alternatively, you need the Fed to succeed in getting us to stop obsessing with the timing of the first hike, which doesn't really matter that much in the long term.
Right.
And to focus more on the journey. And the journey is going to be the loosest tightening in Fed history. It's going to be a very shallow path. It's going to be stop-go. It's not going to be a hike at every meeting. It's going to be a terminal point well below historical averages. So if the Fed can succeed through expectation management in getting us to stop obsessing over the first rate hike and look at the journey, then they'll feel comfortable on going forward.